Class. I'm going to cover some key points for Chapter 13, Corporation, Organization, and Capital Stock Transactions. The learning objectives are Learning Objective 1, discuss in major characteristics of corporation. Learning Objective 2 is explain how to account for common, preferred, and treasury stock. Learning Objective 1, discuss in major characteristics of a corporation, an entity separate and distinct from its owners, classified by purpose, classified by ownership. So basically you have not-for-profit corporations, for-profit, publicly held, and privately held. Examples of not-for-profit are Salvation Army, American Cancer Society, for-profit McDonald's, Nike, PepsiCo, and Google, and privately held companies like Cargill Incorporated, or colleges and universities. Characteristics that distinguish corporations from proprietorships and partnerships. Advantages: separate legal existence, limited liability of stockholders, transferable ownership rights, ability to acquire capital, continuous life, corporate management. Disadvantages are the corporate management, government regulations, and additional taxes. Separate legal existence: corporations act under its own name rather than the name of its stockholders. Limited liability stockholders limited to their investment in the company. Transferable ownership rights: shareholders may sell their stock. Ability to acquire capital: corporations can obtain capital through the issuance of stock. Continuance as a going concern is not affected by the withdrawal, death, or incapacity of a stockholder, employee, or an officer. Corporate management: separation of ownership and management often reduces an owner's ability to actively manage the company. This is an example of a corporation's hierarchy. You would have stockholders who in turn vote on a board of directors, which typically has a chairman. The board of directors help to hire the president, which normally serves as a CEO, chief executive officer, and then the company is normally set up where you have general counsel, a vice president for marketing, vice president for finance, a vice president for operations, and a vice president for human resources. Structures do vary, but this is just an example. And then hence, for accounting purposes, they identify that you normally have a treasurer and a controller. Government relations: a corporation is subject to numerous state and federal regulations and additional taxes. Corporations pay income taxes as a separate legal entity, and in addition, stockholders pay taxes on cash dividends. People normally complain about this, saying that there is double taxation. Forming a corporation: initial steps: you file an application with the Secretary of State within a state. State grants a charter. The corporation develops bylaws. The company generally incorporated in a state whose laws are favorable to the corporate form of the business. Corporations engage in interstate commerce must obtain a license from each state in which they do business. So basically they're saying that most companies kind of shop around to find a state who has laws that are useful or more in compliance on how they want to manage or how they want to conduct business. Stockholders' rights: they vote in election of the board of directors at an annual meeting and vote on actions that require stockholder approval. They share the corporate earnings through receipt of dividends. They keep the same percentage of ownership when new shares of stock are issued. It's called a preemptive right. They share in assets upon liquidation in proportion to their holdings. This is called a residual claim. When a corporation decides to issue stock, it must resolve a number of basic questions. How many shares should it authorize for sale? How should it issue the stock? And what value should the corporation assign to the stock? Authorized stock: charter indicates amount of stock that a corporation is authorized to sell. The number of authorized shares is often reported in the stockholders' equity section. There's no formal accounting entry for authorized stock when it's authorized for sale. Now, when it's issued, the issuance of stock, companies issue common stock directly to investors or indirectly through an investment banking firm. Factors in setting price for a new issue of stock: companies anticipate future earnings, expected dividend rate per share, current financial position, current state of economy, and the current state of securities market. Stock issue considerations: additionally, they have par and no par value stocks. Years ago, par value determined legal capital per share that a company must retain in business for protection of corporate creditors. But today, many states do not require a par value. It really didn't have much relation to the market value. So no par value stock is fairly common today. In many states, the board of directors assigns a stated value to no par shares. Here you have the owner's equity section, and they're illustrating that you have two primary sources of equity: paid in capital and retained earnings. And with paid in capital, you have common stock and preferred stock. This is where your stock is involved. And then you also have paid in capital in excess of par of the stock. For retained earnings, these are the residual earnings per year that is retained by the company for future investments. Paid in capital is a total amount of cash and other assets paid into the corporation by stockholders in exchange for capital stock. That's paid in capital. Retained earnings is net income that a corporation retains for future use. So retained earnings, if Delta Robotics has a balance of $800,000 in common stock and $130,000 in retained earnings at the end of its fiscal first year, its stockholders' equity section is as follows. And this is a partial example of a balance sheet. Paid in capital common stock. So here's your two sections: paid in capital and retained earnings. Paid in capital common stock is $800,000. Retained earnings is $130,000. The total section, total stockholders' equity, is $930,000. Comparison of the owner's equity, stockholders' equity accounts reported on a balance sheet. So basically, all of the accounts for proprietorship, a partnership, and a corporation, the normal balance for all of them are credit balances. So owner's capital is normally a negative balance. Individual capital accounts for Abel and Baker, these are partners, negative balances, not negative, but a credit balance. And common stock and retained earnings are normally credit balances. So proprietorship, partnership, and corporations carry a normal credit balance. At the end of the first year of operation, Doral Corporation has $750,000 of common stock and net income of $122,000. Prepare the closing entry for net income and the stockholders' equity section at the end of the year. So here you'll pull out your data: $750,000 common stock and net income of $122,000. Income summary is debited for $122,000, and retained earnings is credited for $122,000. So A is asking you to close the closing entry for net income. So net income is a temporary account, and net income gets closed to income summary. So normally you would debit net income and credit income summary. So the balance is in income summary. So in order to pull it out of income summary and put it in retained earnings, where all net income ends up at the end of the year, you're going to debit income summary for $122,000 and credit retained earnings. Second, stockholders' equity section, they're going to show common stock of $750,000 and retained earnings of $122,000, which gives you a total of $872,000. It's very similar to the partial balance sheet that we just seen. Learning objective 2, explain how to account for common, preferred, and treasury stock. Accounting for common stock primary objectives: identify the specific source of paid-in capital, maintain this distinction between paid-in capital and retained earnings. Other than consideration received, the issuance of common stock affects only paid-in capital accounts. So here we assume that Hydroslide Incorporated issues 1,000 shares of $1 par value common stock. Prepare Hydroslide's journal entry if 1,000 shares are issued for $1 per share. And then B says 1,000 shares are issued for $5 per share. So here we're dealing with issuance. So our data is 1,000 shares of $1 par common stock, and they're asking you to journalize the issuance. So in an issuance, you're receiving something and you're sending out something. And so here you're receiving cash. So you received $1,000 because you issued 1,000 shares of $1 par value common stock at $1 per share. And here you have to record what you issued, and the par value is $1. The common stock, there were 1,000 shares And so here you credit 1,000. So you debit cash for 1,000, which you received, and you credit common stock 1,000 shares at $1 for $1,000. In B, you receive $5,000. So 1,000 shares are issued at $5 per share. You're going to record the common stock in your books for the dollar that the par value, the dollar is par value of $1. So you still have 1,000 shares at $1. You're going to credit common stock. But the difference between the selling price and the par value becomes paid in capital in excess, and it's going to be of par for common stock. And that's $4,000, which is going to be credited. And that balances out to $5,000. So in illustration B, the selling price exceeded the par value. So here, HydroSlide Incorporated's balance sheet partial. You have paid in capital common stock, $2,000. In excess par of common stock, the $4,000. Total paid in capital, $6,000. And then they're stating they had retained earnings of $27,000, which gives us a total stockholders' equity of $33,000. So this is how a partial balance sheet would look based on those entries. So another illustration, assume that instead of $1 par value stock, HydroSlide Incorporated has $5 stated value no par stock, and the company issues 5,000 shares at $8 per share for cash. And so here again, issuing something, receiving something. You're receiving cash for $40,000, 5,000 shares at $8. The common stock stated value now, because you don't have a par value, but the stated value takes the place of the par value. It was $5 at a stated value of 5,000 shares, so that's $25,000 for common stock recorded on your books. There's going to be a difference, which is paid in capital in excess of stated value common stock of $3 per share, which is $15,000. Assume further that no par stock does not have a stated value and the company issues 5,000 shares at $8 per share for cash. So here, 5,000 shares at $8 per share for cash, you're receiving $40,000. Common stock is $40,000. The common stock's value is the same as the selling value in this scenario. Issuing common stock for services or non-cash assets. So corporations also may issue stock for services to attorneys or consultants or non-cash assets like land, buildings, and equipment. So here, instead of paying cash for something, you're issuing some of your stock. And so cost is either the fair market value of the consideration given up or the fair market value of the consideration received, whichever is more clearly determinable. Illustration. Attorneys have helped Jordan Company incorporate. They have billed the company $5,000 for their services. They agreed to accept 4,000 shares of $1 par value common stock in payment of their bill. At the time of exchange, there is no established market price for the stock. Prepare the journal entry for this transaction. So instead of paying cash here, we were issuing some of our stock. And so we have an organizational expense of $5,000. So we've seen that in the very beginning of the problem. It said we were billed $5,000. So you're going to debit expense no matter what. In a normal scenario, you would debit expense for $5,000, credit cash for $5,000. But here you're not crediting cash because instead of paying them cash, you're issuing stock. So you're going to credit your common stock for $4,000 because the par value was $1, 4,000 shares at $1. And then the difference is going to be paid in capital in excess of par value common stock for the $1,000. Athletic Research Incorporated is an existing publicly held corporation. Its $5 par value common stock, its $5 par value stock is actively traded at $8 per share. The company issues 10,000 shares of stock to acquire land recently advertised for sale at $90,000. Prepare the journal entry for this transaction. So here again, instead of cash, we're using stock. We're getting land for $80,000, $8 per share. The company issued 10,000 shares. The stock has a par value of $5. 10,000 shares at $5 is 50,000. You're going to credit common stock for 50,000, and then again you have a paid-in capital in excess of par value common stock for 30,000 for the $3 difference. $3 times 10,000, so 30,000. And so the land is recorded at 80,000, even though it's advertised at 90, because that's the actual cost that we purchased it at, was $80,000. So accounting for preferred stock. Typically, preferred stock have a priority as to distribution of earnings, dividends, assets in the event of liquidation, and generally do not have voting rights. Accounting for preferred stock at an issuance is similar to that for common stock. And so here, Stein Corporation issues 10,000 shares of $10 par value preferred stock for $12 cash per share. The journal entry to record the issuance is, again, we're receiving cash, 10,000 shares at $12, 120,000. You're recording the common stock, $100,000. So it's 10,000 shares at $10, and then additional paid in excess of par value preferred stock for 20,000. I think here in the illustration, this should say preferred stock. And so the paid in capital in excess of par value preferred stock is the 20,000. So that's the $2 difference between the $10 and the $2. So preferred stock may have a par value or no par value, just like common stock. But again, it's an issue here with the wording. Cayman Corporation begins operations on March 1st by issuing 100,000 shares of $1 par value common stock for cash at $12 per share. Journalize the issuance of the common shares on March 1st, assuming the shares are not publicly traded. So Cayman Corporation begins operation on March 1st, issuing 100,000 shares of $1 par value common stock. So 100,000 shares at $12 is 1.2 million cash. You're going to record the common stock, $100,000 at the dollar par value is $100,000. So the paid in capital in excess of par value common stock is 1.1 million. It's the additional $11. On March 15, Cayman issues 5,000 shares of common stock to attorneys in settlement of their bill of $50,000 for organizational costs. Journalize the issuance of these shares. So here, instead of paying cash for some services, we're paying with our stock. And you're going to record organizational expense of $50,000. Clearly states here we have a bill of $50,000. So we're going to debit organizational expense for $50,000. And we're going to credit common stock for $5,000. They agreed to accept 5,000 shares of common stock, and we already know they're $1 per share. And the difference is paid in capital in excess of par value common stock for $45,000. So again, we have Cayman Company. On March 28th, Cayman issues 1,500 shares of $10 par value preferred stock for cash at $30 per share. Journalize the issuance of the preferred shares. So 1,500 shares at $30 is $45,000 cash Cayman received. They're recording the preferred stock, 1,500 shares at $10 par at $15,000. And then you have paid in capital in excess of par value preferred stock for $30,000. So accounting for treasury stock. So here we have the illustration from before with the two primary sources of equity, the paid in capital and the retained earnings, and the paid in capital where it's involved with the common stock, preferred stock, and the paid in capital in excess that we've already discussed. Here you're looking at a contra account, which is called treasury stock. So accounting for treasury stock is a corporation's own stock that it has reacquired from shareholders but not retired. Corporations acquire treasury stock for various reasons: to reissue the shares to officers and employees under bonus and stock compensation plans, which means if you offer some type of some type of stock compensation. Sometimes if you become an employee, they offer you, you can buy stock or they give you stock. But in order to have that stock to give away, sometimes you have to rebuy stock that you've already sold that are out in the market so you can have enough. Also to enhance the stockholders' market value, sometimes it's a management decision, to have additional shares available for use in the acquisition of other companies, and to increase earnings per share. Companies generally use the cost method, the debit treasury stock for the price paid to reacquire shares. Treasury stock is a contra stockholders' equity account. It reduces stockholders' equity. So here we have an example of Mead Incorporated's partial balance sheet. You have stockholders' equity, which are paid in capital, and your retained earnings. Under paid in capital, you have common stock at $5 par value, 400,000 shares, authorized 100,000 shares issued and outstanding for 500,000, retained earnings 200,000. So total stockholders' equity is 700,000. So on February 1st, 2020, Mead acquires 4,000 shares of his stock at $8 per share. So this entry looks like this as follows. You're going to debit treasury stock for 4,000 shares at $8 per share, and you're going to credit cash for 32,000 because you paid cash to buy back your stock. So again, a debit to treasury stock, 4,000 shares at $8, which is 32,000, and a credit to cash for 32,000. Now the balance sheet after this transaction, you have the contra account, which is less treasury stock, 4,000 shares, the 32,000 that you use to buy back. So now your total stockholders' equity is 668,000. Both the number of shares issued, 100,000, and the number of shares held as treasury, 4,000, are disclosed. So sale of treasury stock above cost. So on July 1st, Mead Incorporated sales for $10 per share 1,000 of the 4,000 shares of its treasury stock previously acquired at $8 per share. The entry is as follows. You're going to debit cash for $10,000. You're going to credit treasury stock 1,000 shares at $8, and then you're going to credit paid in capital from treasury stock the additional $2,000. So you receive $10,000 for the sale. You're going to credit treasury stock for the original $8 per share, the 1,000 shares that you just sold, and you're going to credit the difference in paid in capital from treasury stock. So a corporation does not realize a gain or suffer a loss from stock transactions with its own stockholders. So if Mead Incorporated sells an additional 800 shares of treasury stock on October 1st at $7 per share, it makes the following entry. So cash 800 shares at $7, that's $5,600. Paid in capital from treasury stock is debited for $800, and treasury stock 800 shares at $8. Now here in this situation, you sold the stock back for less than what you purchased it at, and so the treasury stock still needs to be adjusted on the books for the $8, which ends up resulting in a debit to paid in capital from treasury stock. So this account paid in capital from treasury stock is used to offset either a gain or not necessarily a gain or loss, but an adjustment between what you're receiving in cash and what you're sending out of the treasury stock, or what you're bringing back in treasury stock and what you're paying out in cash. So paid in capital from treasury stock is $800. And here they give you an example of the T accounts. On December 1st, assume that Mead Incorporated sells its remaining 2,200 shares at $7 per share and makes the following entry. So cash, $15,400. Treasury stock, which we know we have to credit for $17,600. That's $2,208 per share. And paid in capital from treasury stock is limited to balance on hand, so there's only $1,200 left in paid in capital from treasury stock. So as your book illustrates, when you read it, you run into a situation where there's not enough funds in retained earnings not enough funds in your paid in capital to offset your stock transactions. You have to go into retained earnings, and that's why there's a debit to retained earnings for the difference for $1,000. So that ends the key points. This is the first letter For the password, in order to get into the quiz, the first letter is S. You're going to need to review the brief exercises to get the other 4 letters in order to take the quiz.